Oh boy, we've currently just had the biggest stock market crash since COVID-19 in 2020. The Vanguard All World has plummeted over 10% since the start of 2025, and now analysts are warning of a US recession right around the corner, which isn't good news. And the result is a loss of red for most of us, me included. This is the biggest drop in my portfolio to date in terms of the amount I'm down. I've had a ton of people asking me about my portfolio, how I'm feeling, and what's my plan. So let's talk about what's going on. I'll show you just how much money I've lost, and I'll let you in on how and if I'm buying the Trump dip. So what in the world is happening? Because a lot of people right now seem to be putting out mixed messaging, but it has been quite a fast timeline. It all started in late February when the S&P began to show signs of volatility with concerns over potential tariff implementations by the United States. Fast forward to March 21st, where President Trump announced Liberation Day, set for April 2nd, where he said he would announce extensive tariffs which amplified the uncertainty. Then Liberation Day came on April 2nd, and Trump imposed sweeping tariffs including a 10% baseline on all imports, with higher rates for specific countries, e.g. 54% on Chinese imports. In response, the S&P 500 dropped 4.88%, marking one of the biggest single-day declines. On April 3rd, China retaliated by imposing 34% tariff on US goods, and the S&P fell a further 5.97%. Reports then emerged suggesting a potential 90-day pause on tariffs for most countries, excluding China. Markets briefly rallied but later reversed gains after the reports were refuted, highlighting ongoing volatility. And then on April 8th, just a few days ago, President Trump announced plans to increase tariffs on Chinese imports by an additional 84%, bringing the total to 104% effective at midnight. The announcement led to further market declines, with the S&P 500 down another 1%. He then announced a 90-day reduction of tariffs to 10% for most countries excluding China, as he felt, and I quote, people were getting jittery. In retaliation, we've now got China adding an 84% tariff onto US goods and an effective rate of 125% coming from the US. So we've essentially got a ping-pong match that was going on with Trump and the rest of the world, but now just with China. It's worth noting here that these are very top-line numbers, and there's lots of specific tariffs for every country in different industries. But this has led to huge outrage, with some claiming it's insider trading, but he's definitely manipulating the market to get his own way, because he knows for the most part he can. A worrying sign is when you have BRICS on the other side of the argument, who want to move away from the dollar being the main global power and decreasing their reliance on the USA. When you put the G7 and the BRICS Plus countries side by side, you can see on average the GDP of the G7 was 1.1% in 2024, where BRICS achieved 3.8%, which isn't a great sign. Trump's tariffs play is basically a way of him saying America comes first again. The idea is to protect US industries, shrink the trade deficit, and force countries like China to play fair. It's worth noting he did try this in his first term with tariffs on things like steel, aluminium, and loads of Chinese imports. The pitch was that it could bring back factory jobs and punish companies that rip off US ideas, like he would say China, and fix lopsided trade deals. And to be fair, there were a few wins, like he managed to rework NAFTA into the USMCA and getting China to promise briefly to buy more US farm goods. But overall, it kind of blew up in his face. China and others hit back with tariffs of their own, and US farmers got crushed. The government ended up spending $28 billion to bail them out. Meanwhile, businesses had to pay more for materials like steel, which meant higher prices for consumers, about $816 more per household per year. Plus, jobs were actually lost in industries that rely on imported parts. Still, Trump's doubling down. He sees tariffs not just as an economic policy, but as political leverage. Like when he threatened tariffs on Mexico to push them on border security, his base eats that up. The economists are waving red flags. His new proposals, like a 10% tariff on all imports and over 60% on Chinese goods, could trigger the same old issues over again. Higher prices, supply chains shifting to other countries but not back to the US, and strained relationships with allies. Tariffs might make a strong headline, but they've proven to be pretty blunt and expensive tools. Whatever he's doing, whether it's to force a more advantageous position for the country, or force money into US treasuries, or manipulate it for his pal's own financial gain, as some would claim, it's definitely intentional. It's really funny that everyone's eagerly awaiting Nancy Pelosi's next trade. It's a former Speaker of the House who magically seems to pick amazing companies that win all the time. There's even an X account called the Nancy Pelosi Tracker, which has over 1.1 million followers. So yeah, the last few weeks have been pretty mental. So let me show you just what that's done to my portfolio. Only recently I posted a video showing my investment portfolio with £350,000 invested in the stock market. And as you can imagine, it's been a bloodbath. I think it's really important for me to show you this, and it's a reason I decided to make this video, because it's all good and well me showing you when it's up, but I also want to show you when it's down, because that's a reality of investing. I'll even pop a counter on screen just to add to my pain, so let's go through it from the smallest to the largest of my sizable accounts. I'll exclude a couple of my accounts here because they don't really matter. I've got my mini SIP with Invest Engine that I've not got off the ground just yet. It's only got £9 in it, so it doesn't really matter. And there's my free trade account with around £8,000 in a frozen Russian ETF, which has been delisted. At least that's one benefit of it being delisted, at least it can't get any worse. First is my trading 212 pies, first of which is one with a couple of random holdings in just because I like them. The first one is valued at £2,277, and over the last month it's down minus 13.4%, minus £353. This one has two holdings in it. Ignore this balance score down here as it's not really relevant. I've got Walt Disney down 17.58% in the last month. This one, of course, is massively impacted by the US and it's down £178. And I've also got Rolls-Royce, which is down 6.79%. Luckily, that one has been an amazing performer, so I'm still up 75% overall. In total, although this count is down, I'm still up 41%. I'll include it because it's important for you to show that although it's brutal short-term, long-term it still pays off eventually. Secondly on here is my growth pie, where I hold my magnificent 7 stocks. Oh boy, I've not even looked at this one yet. This one is now only up 9.4% overall, but it was up massively. Let's see the damage in the last 1 month. Minus 8.9% on average, down £640. In terms of the individual holdings, you can see some of them are done okay still overall and some are down. I did make some pretty big gains on some of these though, which is why they're likely still looking okay. Nvidia at one point was up over 100%, and in the last 3 months this one has dropped 23.84% alone. Apple, another one, hammered over the past 3 months, down 22.54%. In fact, over 3 months, this portfolio is down minus 2,258 and minus 26% from where it was, which just shows how big the impact has been on these stocks compared to the S&P 500, which is down under 10%. So while it might have been some of the biggest rises, there's certainly some of the biggest fallers too. That means in total from trading 212 from the peak, I'm down £2,258. That's a lovely start. So next up is my lifetime ISA, which has 2 all-world funds in it, one from Invesco and one from HSBC. One's a mutual fund and one's an ETF, but they essentially do the same job. I have them split like this because of the way HL is set up, and originally it was cheaper to buy the HSBC one, but now the Invesco is cheaper because they've changed their pricing structure. HL is awful, honestly, for seeing your performance, but luckily because I did the portfolio update a month ago, I can see it was at £23,670 and it's now at £20,455. So in 1 month, I'm down a cool £3,215. That increases our total to minus 5,500. And we're not even on the biggest accounts yet. Now you can see why I prefer not to look, right? So okay, next is my pension with Vanguard. Thankfully, this one is better at telling me what's happening. My current value in this account is 102,517. And this is in the FTSE developed world, which is made up of around 70% of the US. So you can imagine how this one's looking. You can see I haven't actually added any money here since November, as I've been unsure about how much I was going to contribute. It actually looks like I've timed the market perfectly on this account, but it wasn't intentional. This account kept growing despite that, and I've reached my peak up here of 124,550. And now, I know what you're thinking, that doesn't look like 102,000, so let's see the damage broken down month by month. So it was minus 4.4k, minus 8k, and minus 9.4k. Quick maths, that's minus £22,095. Yeah, can we all just take a moment of silence for my portfolio? So let's slap that on, why not? And now we're at minus 27,595. And yeah, don't worry, we're not finished yet. On to my ISA. So my ISA actually peaked up here at £160,650 just over a month ago. And today my total is £139,151. The 1 month view isn't as painful, it's minus 9,336. But if we go from my peak, I'm actually down 21,499 in this account too. Believe it or not, this actually hasn't done quite as bad as a SIP, likely because this one has emerging markets as well as developed world in it, so less overall exposure to the US. This account is still up 8.78% overall, so I can't complain, but it sure as hell felt a lot better beforehand and demonstrates how really is a long game that we're playing. This brings my total from my peak to today to minus £49,094 that I'm now down. Damn, we nearly got to 50k there. Cheers, Trump. So long term, realistically, this dip doesn't really matter, and it's your chance for you to buy more. So let me talk about what I'm doing. Well, you remember that big gap you saw in my SIP just a minute ago? I actually really wasn't sure where I stood with my tax and my earnings. For me, it's a no-brainer to invest money into a SIP to avoid the income tax, at least for now, which I've only recently set up. Now, admittedly, they don't have company contributions just yet, which I didn't need before as I was contributing personally to use my allowance up. But for the meantime, I'll be continuing to contribute to my Vanguard account. Confusing, I know, but my income is split between YouTube being self-employed, which is going to turn into a company, and my web design business, so I have to balance it both. But once it all in companies, then I will be reliant on them company contribution. But once IE does get that open, I'll transfer the money over and get it all in one place. So for now, I've got this account right here, which I'm actually smashing the market right now with my 0.43% gains in the last month. But in a year, this one's done 5.41%. But it won't be that high as rates have dropped. But this fund is a really good one that you can hold some cash in. So I built up to £43,000 in there, and I'm waiting on the government tax relief to come in, which usually takes up to 6 weeks. With this money, I'm going to start buying my usual funds. I'm going to invest a good chunk of it today or tomorrow and see what happens and then buy more. The general consensus and statistically is to just get it in there, which is why I don't want to wait forever to do so. But I likely won't be adding more to this account in the short term until the company contributions are added, so I won't be averaging in. But technically, I'm still averaging into my overall position of the portfolio, so it's fine. I'll probably start around 15 to 20,000 tomorrow and then judge it from there. I'm not too bothered about timing it, although it does look like I've done it perfectly, but there's still no telling where the bottom is, so do remember that. I just feel like mentally I feel a bit better about it than lumping it all in and just watching it tank more. And that's from my experience of doing that a few times in the past where I've had to wait an entire year for it to go positive. But the thing is to remember is say I put in £20,000 and it went up 10%. Well, it's only £2,000 on that 20k or minus £2,000 if it went down. It's not my entire portfolio value, which I think sometimes we overlook. The most important thing you can do right now, and what I'm doing, is continuing to add more money and making the most out of it. Or it may look like I'm sitting on cash, and even me leaving 40k in cash, and that 310k invested right now really isn't all that bad. It's not a huge part of my portfolio. I'll be fully invested again within the next 3 months for sure, and I'll be building up more on my cash reserves as I go. I'll have a video coming out soon about cash, as I think it's really important to use in our strategies and I don't talk about it enough. I really do hope it was helpful to see this, and hopefully you can actually feel better about your own accounts now too. I'm going to go and find a dark room to lie down in. Only kidding. I'm actually honestly surprised how much this really doesn't bother me now. Thankfully, 10 years ago, I would have been panicking like crazy. Let's just keep buying more and take advantage of this opportunity while we can. And if you want some more reassurance, I'd highly recommend checking out this video, or this might be of interest too. Thanks for watching, and I will leave you with this. The great Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful."